Well, good morning, everyone. It's March 9th. It's a Monday, and boy, oh boy, oh boy. I told you guys last week that I smelled a rat. I told you last week that the second shoe hasn't dropped yet. And you know what? It's all happening right now. Let's get into it. There's a lot to talk about. The benchmark U.S. crude oil prices were down over 20%, the biggest daily drop since Gulf War in 1991. Can you imagine that? That's really, really, really scary. They were down as much as 30% deep in a rout that began in Saudi Arabia, Russia, and other major producers failed to agree on cutting output to prop up prices. A breakdown in their cooperation suggested they will ramp up output just as demand is sliding. Not pretty at all. Now, these are the biggest percentage drops since January 1991 when the U.S. began airstrikes on Iraq. I remember that day really well and unleashed strategic reserves to cope with the disruption in oil prices. Chinese factories that make world smartphones. This is the big one, actually. This is more disruptive. Smartphones, toys, and other consumer goods are gradually reopening, but they're not expected to return to normal production till at least April. That means next quarter, bye-bye. Apple says slowdown in manufacturing iPhones in China will hurt sales. What a surprise. An airline industry group says carrier could lose as much as $113 billion in potential ticket sales. Adding to the pessimism, China reported Saturday that its exports fell 17%. And imports were off by 4%. And I'm not sure I believe these numbers from a year ago. So things are not looking peachy right now. We needed this. We needed the second shoe to drop before a capitulation could begin. So the crude oil situation was not foreseeable. I'm going to give you that. That was unexpected. But the reaction to the stock market was. So, economic calendar. Folks, we got a lot of news towards the end of the week, like consumer jobless claims, PPI, CPI, petroleum status report is going to be very interesting, but I'm going to be very straight with you. The biggest report this week is going to be consumer sentiment, because consumer sentiment is going to tell us the fear level, and it's going to give us some projections going into the future. It's going to give us a reflection of the GDP. Jobless claims aren't going to feel it yet, but consumer sentiment and import-export prices may. So usually these are not huge reports, but I think they're going to be really big reports this week because of what we're seeing right now in the market. The market is in panic mode right now. Look at crude oil prices. This is overnight. Now, I think we've bottomed out. This is kind of what I wanted to see with the stock market, but we're getting it with the crude oil. And usually when we have a gap down, a substantial gap down, and we close near the top, although we haven't closed yet, so I'm kind of thinking ahead of time. I'm thinking a few steps forward. If we close this gap, if we close higher and start filling in this gap, there's a good chance the oil downside is down. As a matter of fact, I would be a buyer at these levels because we are low right now. The biggest factor, and one that I kept telling everyone about last week, was the Nasdaq. This is what was worrying me. All right. This is what was worrying me. Why? Because here's the problem. What stocks have a bigger impact to this virus? Blue chip stocks or semiconductor, computer stocks, tech stocks? Remember, everything tech is made in Asia, and these stocks are holding up better than everything else. It just makes no sense. So I needed to see the Nasdaq trade below the 200-day moving average because they were just holding on a little too well. And that's when I said the second shoe needs to drop. Look at the Nasdaq 100. We just literally broke the 200-day moving average on the overnight basis. Look at the S&P 500. We broke that. This is the 200-day line. We broke it a week ago. So why were blue chips so much weaker than stocks that had a complete correlation to Asia? Apple, Microsoft, all the factories, Tesla factories, all of these stocks held up. So it's kind of like this downside is being caused by the coronavirus, but stocks that have the biggest sensitivity to coronavirus are holding up the best. And that made no sense to me. But now we're finally starting to see the Nasdaq 100 below the 200-day moving average. Let me show you the momentum level so you'll see exactly what I'm talking about. And folks, I keep talking about the same thing over and over again because it's a huge issue and it's a pink elephant in the room. And until we see a resolution, it's just not going to get better. So, okay, look at the Nasdaq composite. 32% of the stocks trading below the 200-day moving average. That's normal. That makes sense. That's in line with the S&P. Remember this number. Now look at the Nasdaq 100. Look at this. We're at 51%, and it looks like we're going to open. I mean, look at this. We are still, look at the sell-off we had. This is the percentage of stocks above the 200-day. This is out of 100 stocks. And I showed this last week, and I said, look at the sell-off we had in end of 2018, beginning of 2019. We went all the way down to 9% of momentum levels, and here we are at 51%. This is the circle we drew here last week, and we said it needs to really come down to these levels before momentum goes from being overbought to being oversold, which is what we need for the momentum to start building up again. I even went as far as to show you this chart, and I showed you, look at this, look at the last down correction, all the way down. Look at the 2015. Let me show you some further ones. Notice every time we have a correction, notice the red line, we go to momentum levels in the 25th percentile. We haven't done that. We're still near the 50th percentile. That's not normal. That's not normal. And what's really unnormal, now let's say that something happened and it was impacting the US market, blue chips, then this would make sense. But this is impacting Asian stocks, coronavirus, Asia, China, Japan, Korea, right? Where do you think Nasdaq 100 stocks are the companies do their business? Where do you think they have their most vulnerability? Folks, I'm going to say this. The biggest stock in the Nasdaq 100 is Apple. Apple reported this morning right here. Let me show you. Right here. Apple Inc. says slowdown in manufacturing iPhones in China will hurt sales output. Why is the Nasdaq holding up momentum-wise? Why? Doesn't make any sense. S&P 500, we're below the 200-day moving average. Let me go to momentum. Let me show you this. %, right in light. Remember Nasdaq Composite was at 33%? 32%. Look at this chart. Look at this. Every time we come down to these levels, you see the red line? Every time we fall, we come down to these levels. We did it this time. We did it, let me go 20 years back. Look, down, well, this is 2008, it's a little extra, but we went down to 2% or 4%. But typically we go down to 20%, where only 20% of stocks are trading above the 200-day line, and then we bounce back. We went pretty close this time around. We went all the way down to 23%. Last time we went to 20%. The time before that we went to 24%. The time before that we went to 20%, and so forth and so forth. But the Nasdaq, look, down, down, down. We go 20 years. Every time we go down, but not this time. Why is the Nasdaq holding on so well compared to everything else? And this was my beef last week, and I said the second shoe is going to drop. And I think this market's going to cool off till we see this line all the way down in the 25th percentile, which would cause stocks to probably lose about another 1,000 points on the Dow from where we are right now. Will it happen? I don't know. But that's the problem I was seeing last week, and this is why that's the sole reason why I was increasingly bearish. The sole reason. Now, volatility, we have matched volatility from 2011. We haven't matched volatility from 2008, 2009 yet, but we're getting close. Volatility went to 60. We're at 41 right now, right at the second highest level that we've gone to in the last, this is 20 years. So this is real momentum levels we're talking about. So folks, I think the market has more downside to go till we turn around, but we are getting closer. We are getting closer. Let me look at the Dow Jones here real quick for you. Let's see what's going on here. All right, let's take a look here. Actually, let me look at the S&P futures. They're going to give us a better indication. Because the Dow The Dow's down about 1,255 points, and I think it may be closed for the session. The S&P futures, let's see where we're going to open here, if we're going to open today. They may be halted, but this is again, this is historic time. There's the S&P 500. It's so low right now; it's below momentum levels. But we are getting really close to the bottom here, and that's telling me we're very close to capitulation. We may go down a little bit more, but quite honestly, let me show you some potential levels. There's a good chance we'll go down to the 2,800 level. But if we break this level, the 2750 level, there's a good chance we're going to go down all the way to 2,300 to 23,000 on the Dow. Excuse me, 23. Sorry, excuse me. This is the S&P, 2,400 on the 2,400 on the S&P, which would on the SPY be 240 to 230. But again, I'm seeing some support here. I think the market's going to hold right around this level, which would be about 2,800. I would put an alert at the 2,800 and then 2,730 level. Between 2,800 and 2,700, we should peak. The bottom side should bottom out at that level. Again, the Nasdaq 100, it's what's bothering me. It's really bothering me because again, why are the stocks that have such huge correlation to what's happening in the world holding up better than blue chip stocks? It doesn't make any sense. And again, there's too many things out of whack right now, especially with oil, with volatility. Put to call ratio is overdone. The bottom line is I think we're getting close to the bottom, but I think we need to see a little more weakness on the Nasdaq till we do. Now, folks, volatility is here in a big way, actually one of the biggest ways ever. Now, there's a really easy way to protect yourself and make money in this crazy market. I'm not kidding. And no, it's not about being long 100%. You've got to learn to diversify. You've got to learn to hedge yourself. Folks, I've been telling you this for years. Now, I have a strategy. It's called alpha rotation. It does exactly that. It goes long the S&P 500 sectors that are killing it, that are really, really strong, but it also goes short strategies that are losing money or buys puts for it. So it's a really, really good strategy, and it goes long and short. It's beaten the benchmark by a substantial margin. The strategy has crushed this market over the past few weeks. As I write this right now, talking right now, I'm looking at the numbers. We're up 43% since last Monday. And I'll expect we'll even crush it even more if the market volatility keeps moving. We're short energy right now, all right? And oil is getting crushed. We've been short energy for weeks, and we've been making money hand over fist. Folks, alpha rotation is the strategy you want to go to. As a matter of fact, I told anyone who would listen to me in the beginning of the year, and actually end of last year, beginning of this year, we had a turning point class, and I told everyone who would listen to me that this is going to be the strategy that's going to kill it in 2020. And you know what? It's killing it. It's destroying it. Folks, a hedged professional strategy that's proven to work in the current market cycle. The hedge is a energy hedge, and energy's down right now to the lowest level we've seen since the Gulf War. 41% return since Monday. Trades long and short, limited risk. You could trade the ETFs or you could trade limited risk options. It's your choice. But folks, this is the way to take advantage of this market. It's been the way to take advantage of this market ever since this volatility started. And I hate to say I told you so, but boy, oh boy, did I tell you so. Folks who've been in alpha rotation have been sending me the coolest emails ever. I've been getting like the best feedback ever. Roger, it's the best strategy. I love the strategy. I've made this much money. I've made that much money. Follow the link below. This is the time to get in on it. Stop looking at the market. Stop looking at the market and thinking about how much you've lost, and start looking at the market and seeing how much you're making. Don't look at the energy market and say, oi, oi, oi. Look at the energy market and say, oh yeah, it's like that. That's what we've been doing for weeks now. It's been killing it. Follow the link below. I can't say enough good things about alpha rotation, especially during the market we're in right now. Take advantage of it. Follow the link below. Long and short, Pick the sector that's going long and ride it. Pick the sector that's weak, sell it or buy a put. That's what alpha rotation is all about. Don't miss out. Do it now. Talk to you guys soon. Good luck out there. Stay safe.